In 1964, a CEO sent Warren Buffett a letter offering to buy his stock for $11.37.5 per share. 3 days earlier, the same CEO had verbally promised $11.50. The 12.5-cent difference made Buffett so angry, he bought the entire company just to fire the guy. That petty revenge decision cost Warren Buffett $200 billion and accidentally created an $890 billion empire. This is the story of the greatest investor in history, nursing a mistake for 20 years because his ego wouldn't let him quit. In the next minutes, you'll discover why Warren Buffett calls Berkshire Hathaway his biggest blunder despite it making him the richest investor on earth. How a box of chocolates changed his entire investment philosophy and saved his fortune. The legal loophole in insurance accounting that gave Buffett $169 billion interest-free for 50 years, and why one share of Berkshire stock costs more than most people's houses. By the end, you'll understand that the path to $800 billion wasn't genius. It was revenge, stubbornness, and finally admitting you were catastrophically wrong. 1962. Warren Buffett is 32 years old, running an investment partnership out of Omaha, Nebraska. He's already rich by normal standards. His fund manages $26 million. He's made his investors wealthy buying undervalued companies, squeezing out profit, and moving on. Wall Street calls this cigar butt investing. Find a discarded cigar butt investing. Find a discarded cigar, smoke the last puff, throw it away. It works. Buffett spots Berkshire Hathaway, a textile manufacturer in New Bedford, Massachusetts. The company is dying. Production is moving south where labor is cheaper, then overseas where it's even cheaper. Berkshire has 11 factories in New England paying union wages. They can't compete. The stock trades at $7.50. The company has $8 of working capital per share. You're buying $1 for 93 cents. Classic cigar butt. Buffett starts accumulating shares. By 1964, he owns 49%. He's not trying to save the company. He's planning to liquidate it, take the cash, move on. Standard playbook. Then Seabury Stanton ruins everything. Stanton is Berkshire's CEO. Old school textile guy. He knows the company is doomed, but he's trying to keep it alive. Buffett's ownership makes him nervous, so Stanton makes an offer. The company will buy back Buffett's shares. Get him out. They agree verbally on a price. $11.50 per share. Buffett says fine. He'll make a quick profit and disappear. 3 days later, the written offer arrives. $11.37.5, 12.5 cents less than promised. On Buffett's position, this is about $3,000. Pocket change. Stanton probably thought Buffett wouldn't notice or care. Buffett noticed, and he cared. In interviews decades later, Buffett described his reaction. Pure rage. He felt disrespected, lied to, cheated out of 12 cents. The rational move was to take the $11.37.50, walk away, invest somewhere better. Textiles were dying. Everyone knew it. But Buffett's ego took over. He bought more shares, took control of the company. May 10, 1965. Warren Buffett becomes chairman of Berkshire Hathaway. First order of business? Fire Seabury Stanton. Revenge complete. Then reality hit. He owned a dying fabric business. Revenue was $50 million a year. Profit was $175,000. That's a 0.35% margin. You could put the money in a savings account and earn more. The company had 2,300 employees, 11 factories, and zero competitive advantage. Foreign manufacturers were paying workers 1/10 of what Berkshire paid. The math didn't work. Buffett knew this. He'd done the analysis before buying, but analysis was for liquidation. Now he was in charge, and Warren Buffett doesn't fail publicly, so he tried to turn it around. He shut down the worst factories, invested in new equipment, tried automation, squeezed costs. For 2 years he poured energy into the mills, lost money every quarter. By 1967 it was obvious. This wasn't fixable. The entire American textile industry was collapsing. It didn't matter how smart you were. But Buffett had a realization. He didn't need to fix textiles. He needed to use the corporate shell for something else. Berkshire Hathaway was a publicly traded company. It had a legal structure, cash flow, even if tiny. He could buy other businesses under the Berkshire umbrella and build a conglomerate. The textile operation could die slowly while he built something new underneath. March 1967. Buffett buys National Indemnity, an insurance company, for $8.6 million. Nobody paid much attention. Insurance is boring. But Buffett saw something nobody else did. Insurance companies have float. Here's how it works. Customers pay premiums today. The insurance company invests that money. Claims get paid years later. The time in between, the money just sits there. Most insurance companies invest it conservatively in bonds. Earn 3 or 4%. Play it safe. Buffett had a different idea. What if you invested the float in stocks, in entire businesses? You're using other people's money, interest-free, and if you invest well, you keep the profit. The risk is, if claims exceed premiums, you lose. But if you price insurance correctly, you get paid to borrow money. National Indemnity gave Buffett $39 million in float in 1967. He immediately started buying stocks. Washington Post, G.I. Co. Sees Candies. Used insurance premiums to build an investment portfolio. The manufacturing side kept losing money, but the insurance operation printed cash. By 1970, Buffett basically ignored the textile side. He had managers running it. They did their best. It wasn't enough. Every year, losses. Every year, Buffett would consider shutting it down. Every year, he'd keep it open. Why? Guilt. Those 2,300 workers had families. They'd worked for Berkshire for decades. Closing the mills meant destroying an entire town's economy. Buffett felt responsible. So he subsidized a dying business for 20 years out of obligation and stubbornness. Charlie Munger, Buffett's business partner, begged him to shut it down. Munger's brutally rational. He'd say, "Warren, textiles are dead. Every dollar you spend is wasted. Close it." Buffett would nod, agree, and then keep the mills open another year. But Munger was changing Buffett's thinking in a bigger way. Munger hated cigar butt investing. He'd tell Buffett, "Stop buying garbage companies at cheap prices. Buy wonderful companies at fair prices." Buffett resisted. His entire fortune came from buying undervalued junk. Why change? 1972, Munger finds See's Candies, a California chocolate company. Small, family-owned, beloved brand. The owners want to sell. They want $30 million. Buffett analyzes it. The company earns $4.2 million a year. $30 million is 7 times earnings. Buffett's usual rule is 3 times earnings maximum. This is too expensive, Munger argues. See's has a brand, customer loyalty, pricing power. You can raise prices every year and people will still buy because it's See's. That's worth paying for. Buffett is skeptical. Paying above book value feels wrong. Munger won't let it go. They compromise. $25 million. Buffett buys See's Candies in 1972 for $25 million. He thinks he overpaid. Over the next 50 years, See's generates $2.1 billion in profit. It requires only $40 million in additional capital investment over that entire time. The return is 5,150%. One of the best investments Buffett ever made, and it teaches him the most important lesson of his career. Munger was right. Quality matters more than price. A wonderful business bought at a fair price will crush a fair business bought at a wonderful price. See's Candies works because the brand has pricing power. Berkshire Hathaway textiles fail because commodities have no pricing power. This realization changes everything. From 1972 forward, Buffett starts hunting quality. He buys Coca-Cola, the Washington Post, Nebraska Furniture Mart, companies with brands, moats, competitive advantages, things that can't be copied. But he still won't close the textile mills. 1976, he shuts down 7 of the 11 factories, keeps 4 running, still losing money. 1980, down to 2 factories. 1985, finally, he closes the last one. 20 years after taking control, Berkshire Hathaway stops making textiles entirely. In his shareholder letter that year, Buffett writes a remarkable confession. He explains that he knew textiles were doomed in 1965, that every dollar spent trying to fix it was wasted, that he kept it open for emotional reasons, not economic ones. He admits the whole thing was a mistake, driven by pride and revenge over 12 cents. Then he does the math. If he'd bought a good insurance company in 1965 instead of Berkshire Hathaway, and ran it the same way, it would be worth $200 billion more. $200 billion left on the table, because Savory Stanton short changed him 12.5 cents and Buffett couldn't let it go. But here's the twist. While the fabric business was dying, the insurance business was exploding. National Indemnity's float grew from $39 million to over $100 billion by the 2000s. Buffett used that money to buy Burlington Northern Railroad, Precision Cast Parts, massive utility companies, and stocks. Billions in Apple, Coca-Cola, American Express, Bank of America. Berkshire Hathaway became a holding company for the best businesses in America. The textile operation was completely gone, but the legal shell remained. Buffett never changed the name. He wanted the reminder. Every shareholder letter mentions the textile mistake. He wants investors to know that even the greatest make catastrophic errors. The stock price tells the transformation story. 1965, $18 per share. 1975, $91. 1985, $2,700. 1995, $30,000. 2005, $88,000. Today, $627,000 per share. That's not a typo. One share of Berkshire Hathaway Class A stock costs $627,000, more than most houses, the most expensive stock in American history. If you bought one share in 1965 for $18 and held it, you'd have $627,000 today. That's a 34,833% return. Buffett refuses to split the stock. Every other company splits to make shares affordable. Apple splits, Tesla splits, Amazon splits. Keeps the price under a few $100 so regular people can buy. Buffett says no. He wants the high price. It filters out speculators. Day traders can't afford it. Only long-term investors buy Berkshire. The result? Lowest stock turnover of any major company. Shareholders hold for decades. In 1996, people complained so much that Buffett created Class B shares. Each Class B is 1/1500th of a Class A. Today, Class B trades around $4 to $18. Still expensive, but accessible. The Class A remains untouched, $627,000 and climbing. The insurance float strategy became Buffett's superpower. By 2024, Berkshire holds $169 billion in float. That's $169 billion of other people's money that Buffett invests. And here's the insane part. The cost of that capital is negative. Berkshire's insurance companies are so well run, they make an underwriting profit, meaning customers pay premiums, Buffett invests the money, and the insurance operation itself is profitable even before investment returns. It's like getting a $169 billion loan at 0% interest, and the bank pays you $2 billion a year to take it. No other investor in history has had this advantage. It's legal, brilliant, and completely unreplicable. People ask how Buffett picks stocks. The stocks are secondary. The structure is primary. He has permanent capital from insurance float. He never has to sell. He can wait decades for investments to compound. Regular investors need liquidity. Buffett doesn't. That patience is worth trillions in aggregate. Seabury Stanton never saw any of this. He died in 1967, 2 years after being fired. He saw Buffett take over a dying textile company. He probably thought Buffett would fail. He never knew that Berkshire Hathaway would become worth $890 billion, that his decision to save 12.5 cents would create the greatest investment vehicle in history, that his name would be remembered only as the guy who accidentally made Warren Buffett build an empire out of spite. There's a dark irony here. If Stanton had honored the $11.50 offer, Buffett would have sold and walked away. Berkshire Hathaway would have died quietly in the 1970s, some other textile company forgotten by history. But because Stanton lowballed him, Buffett's pride took over. He built something that should never have existed just to prove he could, and it cost him $200 billion in opportunity cost. But it made him $120 billion in actual wealth. So did he win or lose? Buffett says lose. He's told interviewers dozens of times that Berkshire was a mistake, that he should have bought a great company instead of a terrible one, that the 12 cents of anger cost him the biggest fortune in investing history. But everyone else sees it differently. To the world, Berkshire Hathaway is the model, the greatest investment company ever built. Buffett is the Oracle of Omaha, the man who turned $18 into $627,000, the genius who used insurance float to buy America's best businesses. The lesson isn't that revenge is good, it's that even catastrophic mistakes can become generational successes if you adapt. Buffett's genius wasn't buying Berkshire. It was recognizing the textile business was dead and using the corporate shell for something else. It was listening to Charlie Munger even though it contradicted everything he believed. It was admitting in public, in shareholder letters read by millions, that he screwed up, and here's what he learned. Most CEOs hide mistakes. Buffett puts his on the cover of the annual report. Every year he writes about Berkshire's origins, the revenge purchase, the wasted 20 years. The $200 billion opportunity cost. He wants shareholders to learn from his failure, and they do. Berkshire Hathaway shareholder meetings are legendary. 40,000 people descend on Omaha every year. They call it Woodstock for capitalists. They come to hear Buffett and Munger talk for 6 hours, take questions, discuss mistakes, share lessons. It's a cult, but a cult based on transparency and learning. Buffett is 94 years old now, still chairman, still making decisions. Berkshire's market cap is $890 billion and climbing. He owns 15%, worth about $120 billion. He's pledged 99% of his wealth to charity. When he dies, over $100 billion goes to the Gates Foundation and his kids' foundations, the largest charitable transfer in history. But there's a catch. He maintains voting control of Berkshire beyond his economic ownership through share class structure. He'll control the company until he dies. Then the shares convert, control passes to trustees, and the empire gets dismantled slowly. Because Buffett knows what he built only works with him and Munger. Nobody else has the temperament, the float, the track record, the patience. Charlie Munger died in 2023 at age 99. He saw Berkshire go from a failing textile mill to a trillion-dollar empire. He spent 50 years telling Buffett, "I told you so," about quality investing. Buffett spent 50 years agreeing. Their partnership changed investing. Before Buffett and Munger, everyone focused on price. After them, everyone focuses on quality. See's Candies is still owned by Berkshire, still printing cash, still teaching the lesson that brand value and pricing power matter more than balance sheet metrics. Buffett visits the Los Angeles store every time he's in California, buys peanut brittle, thanks employees, reminds himself that a box of chocolates changed his philosophy and saved his fortune. The textile mills are gone. The buildings were torn down or converted to condos. The workers retired or found other jobs. New Bedford never recovered its textile glory. But Berkshire Hathaway, the name, survives, not as a manufacturer. As a monument to the most expensive lesson in investing history. If you bought one share in 1965, you'd have turned $18 into $627,000. If you bought 5 shares, $90 into $3.1 million. If you'd invested $10,000, you'd have $348 million today. The returns are almost unbelievable, and they came from a company Buffett calls his worst investment. That's the paradox. The greatest success built on the biggest mistake. The revenge purchase that accidentally created the perfect structure. The decision driven by wounded pride that forced Buffett to innovate his way out of disaster. If Berkshire had been a good business, Buffett might have run it as a textile company, made a decent return, stayed in his comfort zone. Never discovered insurance float. Never learned the quality lesson. Never built the empire. The failure forced the evolution. The mistake created the method. The anger generated the fortune. Not because revenge is smart, but because Buffett was talented enough and humble enough to recognize when he was wrong and build something better on top of the rubble. So what's the lesson? Don't buy failing companies out of spite. Don't let pride override analysis. Don't waste 20 years on a dying business. But if you do, be smart enough to use the shell for something better. Listen to people who tell you you're wrong. Admit mistakes publicly. Learn faster than you fail, and never ever shortchange. Warren Buffett by 12.5 cents. Sabery Stanton saved his company $3,000 with that lowball offer. He created an $890 billion monument to why you should always honor your word. Every share of Berkshire Hathaway is a reminder that small slights have compound consequences, that wounded pride is expensive for everyone involved, that the greatest fortunes sometimes start with the dumbest decisions. Warren Buffett turned a failing shirt company into $800 billion. But he didn't turn the shirt company around. He killed it, used its corpse as a shell to build an insurance empire, learned that quality beats price, admitted his mistake for 60 years, and left $200 billion on the table because he couldn't walk away from a 12-cent insult. The fastest path to $800 billion wasn't genius. It was revenge that became a mistake, that became a learning experience, that became a fortune. And somewhere in Omaha, a 94-year-old man sits in an office with a Coke and a box of See's Candies, writing his annual letter about the day he bought a terrible company for the worst reason and accidentally changed investing forever. The market cap says he won. Buffett says he lost. The truth is both, and that's the most valuable lesson of all.